The Federal Reserve, or Julie was there at the Federal Reserve, holding interest rates at a 23-year high this week while reducing its estimates of rate cuts this year from 3 to 1. These higher rates are good for short-term savers due to higher yields on savings accounts like CDs. Here with more, we've got Yahoo Finance's Kerry Hannon. Hey, Kerry.
Hey, Brad, great to be here. Yeah, savers should be dancing that happy dance, the jig, whatever it might be. This is great news. For right now, these are some of the highest rates we've seen for savers for the accounts you just mentioned, for money markets, for online savings account, high yield ones. We've got T-bills are looking great, money markets. These are areas that you can just swish some cash over into, and it's a great area for peace of mind, particularly for people who are nearing retirement or in retirement. Because here's what happened, Brad. A lot of people actually slow down and they don't realize how much they're likely to spend in the early days of their retirement. And so they don't put enough cash aside. This is a perfect time to set that cash aside so you can pay yourself, have expenses, living expenses, for maybe a year or two shifted into some of these accounts. And these are the kinds of rates we're seeing, okay? If you look around, they're over 5% easily. I saw a one-year CD yesterday for 5.65%. And T-bills are paying are yielding over 5%, and they are exempt from state and local tax. So these are all some really great ways to kind of build a risk buffer, I like to call it.
So, Kerry, is it time to dump all your money into these short-term savings like CDs, or do you need to stay diversified here?
No. Hold down. You got to hold your horses on this one. We all still need equities in our portfolio because, hey, we're talking about living to 100, a lot of folks. So if you got that kind of longevity for retirees too, come on, you've got to be thinking of the oomph you can get from the equities. And we know that that's an important engine to keep our money growing for us over the long term, even if it's 10 years, 20 years. The S&P 500 index is up, I think it's something like 10.7% since its inception annually. So, think about that. Stocks are an important part of the equation. One sort of, it's a standard thing that people often say. It used to be take 110 minus your age, and that's how much should be in equities. Today, people are saying because of the longevity, let's go with 120 minus your age for how much you should have in equities. But don't ignore these great rates that we're seeing right now for these short-term savers.
Kerry, thanks so much. Appreciate it.